Hi, a very good afternoon, everybody. So, this marks the 50th edition of Netra. We started writing this back in 2021, and this month, it's been 50 straight months of digging in, putting out clear, thought through insights to help you navigate the markets better. The goal has always been simple: consistency and clarity. And this month is no different. So here's how our this month's edition is structured. So we have sectioned the report into four parts. The first part, I'll just give you a gist of how the four parts are structured. The first part, so we'll talk about how, despite India delivering outstandingly across all segments, be it growth, be it earnings, be it macros, we are still seeing weak or even negative foreign investment. And here we dig into the why. In the second section, we talk about we take a step back from the dominant de-dollarization narrative and offer a slightly different lens on how to give view on how to view gold and the dollar in the current global context. Third, we'll talk about where the numbers are and what they're really saying about the Indian corporates. And in the last section, we talk about and try to understand how this growth phase compares with the past cycle and whether it even qualifies as a traditional cycle at all. So, during the course of the presentation, you can ask your questions. There's a question answer tab on your screens below. And now I will let Sahil take over.
Thank you, Pragati, and good evening to all of you. So today we'll talk about the 50th edition as Pragati highlighted, and idea will be to focus entirely on the insights that we've gathered and talk about them in detail. I will want to cover all the four sections in propriety. So it might take slightly longer than what we usually do, but we'll talk about all the sections very clearly. So first we'll talk about the flows section and the shaky US dollar channel. And this I think is a very important section. It will talk about things which a lot of times get misinterpreted in the market. Specifically, we'll start from foreign flows. And as you all know that in last 3 months, a lot of data came out which showcase that foreign flows into India has been quite dismal in FY25. And what are those numbers? We'll talk about these numbers, that what were those numbers. So when you look at the numbers in the last financial year, the net foreign direct investment into India was less than $1 billion. Now, you will have to go back to FY03 to find such a number where Indian GDP was a fraction of what it is today. So comparing to what we are in terms of size today, bordering $4 trillion, getting less than $1 billion is very, very low. It's actually surprising. If you had spoken about India getting $1 billion or less in FDI, just about 5 years ago, it would have been a point that you would have dismissed very quickly. But here we are today, and also foreign portfolio investment, which is what we call FPI investments, they have also been very, very low. We saw a large sell-off from FIs last year. This year they have been quite flattish, but we haven't seen very large numbers coming in. So in totality, the point is that we haven't been getting large FI flows. In fact, the chart on the right-hand side, top corner, shows you the total flows into India in last year was $4.5 billion, which are very, very low. Um, and if you look at last 5 years, and if you were to make a hypothesis on how and why will India get hundreds of billions of dollars in FI flows? And if you could imagine what could we do to get very high FI flows? So I put down some of the actual numbers of what has happened in the last 5 years. India's nominal GDP growth has been 10.5%, real GDP growth close to 5% CAGR. Equity earnings growth is 20%. Equity index returns 24%. These are all CAGR number, annualized returns. Rupee volatility has been 4%. Inflation is 5.6. And we've also offered a real return, inflation adjusted on government securities of 1.4%. Now, what do these numbers tell you? All these numbers are top of the line among all emerging markets. If you take a emerging market average or take the best performing emerging market, India will feature at the top in almost all these categories, whether it was low volatility for currency, stable inflation, high real rates compared to other countries, high GDP growth, stellar earnings growth from equity, and equity returns are also one of the best in the world. And still, the outcome is that after 5 years, we get to a year where we have hardly any flows. And in fact, if you look at the totality of flows, you will find that in FY 21 and 22, we saw very large gross inflows of 85 billion dollars, and our repatriation, which was money flowing out, was much smaller, right? You can see that 18 billion became 27, 29, but recently repatriation has become 51 billion. So a large amount of corporates, you could say that they have sort of taken out their money, which came through FDI. In colloquial terms, you could say that they have booked profit and gone out, right? And also the FDI coming out from India, which is Indians investing outside, which is FDI by India. That number has also gone from about 13 billion to about 29 billion. So these numbers have also more than doubled in last 5 years. So the total impact is that your gross number hasn't grown, which is stuck at uh, close to $80 billion, which it was in FY 21 and 22. But your repatriation and outflows have gone up significantly. So this has sort of reduced the FDI numbers, and the FPI numbers have also not been very high. One reason could be that valuations have not been very supportive. It has made sure that a lot of foreigners sell equity domestically, whether it was in secondary or primary market, and take out money, because India has offered very high valuations, and lot many promoters will be more than willing to pass on their shareholding to other investors who are willing to accept it. And same is the case with even domestic promoters, right? A lot of promoters have sold their stake, and FIs are no different. You can see that foreign investments have also sold and repatriated money. And similarly, Indians have also looked for better investing opportunities outside. And since not many avenues are available to invest outside because of various restrictions, FDI has actually flown out significantly. So two key points: that if over the last 5 years, if India has delivered such stellar numbers, and very few markets can boast of delivering such numbers in terms of growth and returns, and still you do not get the flows, then when will we get these flows? This combination of delivering great outcomes and also foreign capital accessing emerging market, it will not occur repeatedly, right? So two things are needed. One, that India continues to deliver steadily, and also foreign capital flows to emerging market. So the second channel, which is foreign capital flowing to emerging market, has been slowing down. So the chart on the right hand side at the bottom, you can see that after the big surge for China in 90s, and then again two more surges for China in 2005 and 2010, FDI since then has been on a downtrend. So global FDI as a percentage of GDP, which was close to 5% in the noughties or mid 2000s, has declined to less than 1%. Now, these numbers are surprisingly low, but it tells you that FDI has been falling globally. And it is not only India which has got low FDI, it's a global cyclical phenomena. Now, how long will this cycle continue? That I'm not sure. I don't know what the future holds. But for now, foreign capital has abandoned not only emerging markets, but global markets also. Not many borders are being crossed by foreign capitals through FDI globally. Maybe a lot of FPI flows have happened globally, and lot many of that has gone back to US. But FDI capital hasn't been flowing, and it's not the phenomenon of the last 2, 3, 4 years. In fact, we saw an uptick after COVID, a small uptick in 2 years, and then it declined significantly, right? So maybe it's a structural change, maybe it's a cyclical change. Uh, Data may tell us that it's a cyclical phenomenon and this can reverse in the future. But to go back to the 2000 era will take a Herculean change in a lot of things globally. So for now, foreign inflows are muted, and the belief that we can get hundreds and billions of dollars of net FDI, not gross, net FDI, still eludes us, right? India has the numbers, has the delivery, but this global landscape has changed dramatically, and that is what is, sort of hampering these inflows. Maybe in FY 26 we'll see improved numbers. FY25 was exceedingly bad, so maybe we'll see a rebound in 26. It's quite possible, but can we get sizable numbers which can change the complexion for India's balance of payment? Unless this global cycle changes, it's very hard. Now we'll inquire into what does this global cycle mean? Why is global capital not flowing as it should, right? So one channel for global capital or the dominant channel is the US dollar. Now, US dollar flow is a very, very important channel for global capital. And how does it flow? It takes two various forms. One, when US runs a trade deficit, which means that it buys goods and services from the economy, particularly goods. It runs a deficit, and the other countries run a surplus, and that is the channel through which dollars flows into the world, right? That is the channel. The other channel is capital flows, where investments are made from US to other parts of the world. Usually, this channel is the reverse for US because a lot of people are purchasing US assets, particularly the US Treasury, and I will talk about it. And therefore, trade channel becomes a very, very dominant factor for US dollar to flow, right? Um, so let me highlight what this channel means and put it in the right context in today's world, right? So first, look at the chart on the right-hand scale. This is the global trade flow, which means that how much import and export is happening globally, which is the blue line, and the red line is the US trade deficit. So you can see that if the deficit in US grows, the global trade flourishes. And when the global trade flourishes, lot of emerging market economies, because they are exporters, benefit from it. So prior to 2008, which is the global financial crisis, US was a dominant importer of energy. It imported huge amount of crude oil because it was not able to produce what it consumed, and it consumed huge amount of oil, and therefore lot of global trade flows was linked to oil, and oil was known to be the secondary gold, right? And then after GFC, not nothing to do with GFC, but US found shale oil, and since then and till now, the US production of oil went from 1 or 2 million barrels per day to about 13.5 million barrels per day. So much so that US has now become a net energy exporter. You can see the chart on the left-hand side bottom. US current account balance, which was deteriorating significantly until global financial crisis, jumped significantly. You can see that because of global financial crisis, but it did not go back down because US started to create its own energy backup. So these two unknown events or uncorrelated events happened together and reduced US trade deficit. And this is one of the primary reasons why emerging markets could never recover after global financial crisis. And this is also one of the primary reasons why when a lot of people, specifically macro analysts, tell you that because the dollar index is declining, emerging market stocks should break out. It doesn't work like that, right? And why is it not working? Because the channel through which US dollar or the money flew from US to emerging market, it broke when US started to become a net energy exporter rather than a big importer. That money which was flowing out, it stopped, right? And then post-COVID, something dramatic happened. You can see US trade deficit once again widened significantly, and this got reflected in huge amount of appreciation for a lot of emerging markets, right? And specifically those emerging markets like India, which showed an earnings growth, right? You saw huge performance, huge flows. Even FPI flows were healthy for a few years. FDI flows were healthy, which showed in the last slide, 80 billion dollars of gross inflows. You can go back and see these same numbers for many other markets, right? Many other emerging markets. But in totality, things did not go back to the extent that it was during the pre-GFC era. These numbers are in absolute billions. If you do it as a percentage of GDP, they will look smaller. That means the deficit that US had to run for the global markets to continue to flourish is much smaller today. And why does the US need to run a deficit? Because it's the reserve currency of the world. So once you become the reserve currency of the world, by virtue of holding the reserve asset, which is the US dollar, you need to import a lot more so that you can export the dollar and the other countries can use that dollar and create savings. And I think this is a concept which is getting challenged right now because US is trying to challenge it that it does not want to run this deficit. And if it does not run this deficit, global economy will be starved for the dollar, and the global inflationary cycle or growth cycle will severely get hampered, right? So now think about it this way. Currently, what US is doing, it is trying to put some checks and balances on its trade deficit. You can see repeatedly using trade war channel, it has tried to avert this trade deficit, and by doing so, it has also seen some amount of depreciation for the dollar. So dollar index, which was 110, is now about 97 or so. Mix of trade barriers, slowdown which it will create, and a weaker dollar will eventually repair US trade deficit. It will reduce the US trade deficit by either doing a slowdown in growth or by the virtue of the currency depreciation that it will cause, which it is already causing. And once this deficit goes down, the channel through which the US dollar flows to the world economy will be broken significantly. And this is one of the biggest risks to global growth right now. I don't think it is priced by the market today. And you can see the chart, last chart, which I haven't spoken about today, is the memo item. These are the dollar assets which US Federal Reserve holds for other countries or other institutions. You can see it was significantly growing when US was running high deficits, and then it became completely sideways. That means other countries stopped getting or creating these reserve assets globally. And you can see this data will repeat in many other countries' FX reserve. You will see that China's FX reserve have been stagnant at 3.5 trillion for more than a decade now, and it will repeat in many other countries, similarly stagnant FX reserves. And the reason for that is that the channel got broken, where these deficits stopped coming for US. And post-COVID, as I said, a large deficit did occur, which you can see in the huge market performance, huge economy rebound that happened in many emerging markets, except China, which we will speak about in some detail. But for now, it does appear that this channel is sort of slowing down, and the US focus on its trade deficit. And now some focus is also coming on its fiscal deficit, although the current administration has gone back on its promise. Earlier, it promised twofold path. One, that it will try to curtail the trade deficit, which is one balance sheet, which is the trade balance sheet. And second, it will try to curtail the fiscal deficit. This is what the initial promise was when this administration came to power. It created Doge, etc. Had it been successful in doing both, it would have sent a massive deflationary shock across the world. For now, it has more or less failed, and that is why markets have cheered in what it has done. But by prolonging these trade wars and by depreciating the dollar, it will at least succeed in doing one, which is managing its trade deficit, and that will probably cause some amount of heartburn or slower growth for many countries. And also, one question that may have, that if US is net exporter of energy, what caused this large deficit? I will take a sidestep with one line comment that you have seen and read that chips is the new oil, right? Semiconductors is the new oil. And the reason is that US is now importing almost identically so much semiconductor that it used to import oil in the 2000s. And that is the reason why this deficit for emerging market became fruitful, specifically post-COVID. And I think those numbers are also now slowing down. And as you can see that US is trying to create its own infrastructure to produce these chips. And if you get this equation right, they all fit the same scheme of things. If US succeeds in doing this, it will reduce its trade deficit once again and cause more heartburn for countries which export to United States. So this is one US dollar channel which sort of is broken and possibly causing some pain for other emerging markets. My sense is that this is just the beginning of this pain getting eventually rectified when US, sorts of comes down on its trade deficit. That repair could be a knee jerk. It could take some time, but in any case, it will be a problem for other countries which are net exporter to United States, including countries like India, where we have very large services surplus, right? And I'll talk about that, that is important. But now let's marry this to the equation of US dollar and to think about how gold comes into the picture, how gold benefits. One conclusion from the first section is that for now, the trade war and some amount of fiscal thinking that the US is doing is going to send some deflationary signals to other emerging markets by stopping this US dollar flow. And it also has one more important outcome, which is that undermining the reserve currency status of US dollar. Okay, we'll talk about that now. So when we talk about the US dollar, and a lot of people think about the dollar as the reserve currency, in fact, dollar is only a medium of exchange, right? When central banks or investors purchase dollar, they don't purchase the dollar note, they purchase US dollar assets. And most often it is the US Treasury. So when I'm talking about the dollar, we are actually talking about the US Treasury. A lot of times you would have seen this chart being made that in the last 100 years, dollar has lost 96% of its value because of inflation. These are some of the most, maybe if I use the word stupid ways of depicting finance because nobody holds the dollar note over a 100-year period, right? What do you hold is US Treasury paper. And if you take US Treasury paper, it very well has protected value, not as much as you would have grown in stocks or other investments, but it was able to protect the value of the US dollar if you were invested in US Treasury, right? And that is what you hold. You don't hold the dollar note, right? And so the point is that when we talk about the dollar in a broad sense, we are talking about US dollar assets, right? And those US dollar assets are and were the official reserve assets of the world. So if a central bank or a country, for example, India or China or any other emerging market or developed market, wanted to park its surplus into an asset, it chose the US dollar as the first port of call. So the left chart that you see on your screen shows what is the status of different reserve assets. You can see that US dollar is almost 46% as the official reserve asset globally. And then there is the euro, which is nothing but a reflection of the US dollar because euro itself is backed by USD, gold, and the NATO, right? And there are other currencies, and then there is gold. So gold initially was a large part, almost 20%. Then it went back to about being 10%, and now it is back to 20%. So it has gained significant share in terms of being one of the reserve assets of choice today. Over the last 5, 6 years, this transition has happened. And central banks are now, you can see that we put a longer chart courtesy ECB. We took the data from ECB. You can see the official reserve holdings and real gold price. You can see the gold holdings have gone up significantly, official gold reserve holdings. And when did this transition start? It started actually somewhere close to the Russia-Ukraine war. Something happened with global central banks. They said that we want to hold more gold rather than holding fiat currencies. And one reason was that US started using the US dollar as a weapon for sanctioning other nations. And there was a fear among many countries that you could actually see your reserves getting utilized or sanctioned, and you will not be able to use your reserves if they are denominated in US dollar, which is what happened with Russia. So many countries started to increase their holdings of gold as the reserve asset. And this is something which has benefited gold prices significantly, which you already know. And we have termed it as re-goldization rather than what the world was talking about, which is de-dollarization. So in fact, the world has not de-dollarized. In fact, if you look at the absolute levels, holdings of US dollar as a reserve asset or US Treasury, which I mentioned earlier, has remained stable. But if you look at the mix, they have gone down. Why? Because holding of other non-dollar assets, particularly gold, which has gone up, right? And this is, I think, one of the most important points. And one clear reason why this you can't second guess is when it will end is a very, very important point which I want to make here. So at any point in time, if any country holds the reserve asset, currently it is the United States, it becomes a very large debtor nation. It takes a lot of debt. And why does it take a lot of debt? It runs a large trade deficit. And why does it run a large trade deficit? Because it makes sense for that country to use the currency, keep its cost lower, and use that for prosperity, right? So it runs a very large trade deficit. And because of virtue of large trade deficit, other nations hold the dollar. And when they hold the dollar, they want to invest in a dollar denominated asset because US is the dominant country and currency in the world. So they end up buying the US Treasury. And when they end up buying the US Treasury, it gives uh, creditor status. For example, let's say there are two nations, one is US, the other is China. US consumes a lot of other goods which China makes, creates a trade deficit, China creates a trade surplus. The dollar that China gains is reinvested back in US Treasury. And by this cycle, the US becomes a net debtor nation and China becomes a net creditor nation. Now, come 2024-25, US says that I don't want to remain a creditor nation. I don't want so much debt. I want to reduce my debt. I don't want to remain a net importer. I want to create my own manufacturing. And it wants to reverse this cycle. How will it reverse this cycle? By reducing its indebtedness, by becoming a smaller debtor nation. It wants to deleverage, whether it is the balance of payment or fiscal deficit, both it wants to delever. The moment it wants to deliver, you need one more very large country which will lever up, which will take more loans, right? Currently, the only country which can do that is China. And unfortunately, even that country is deleveraging. It wants to reduce its debt. It is deleveraging its real estate sector, its banking sector, its NBFC sector. So currently, any large nation, which the third one is Eurozone currently, which doesn't have the capacity to lever up other than Germany, which is trying to do, but Germany alone cannot create sufficient consumption across the world. It is only US which can create it, or maybe China, but China has a very different model. And when you think about these factors put together, it is very clear that the only way out is a what is called depreciation of all fiat currencies, which is what is happening today and which is benefiting gold by a very large extent. It's a longish explanation, but it is now being reflected in more and more data. We've spoken about this in the last 2 years, but now more data is available. You can see in the last 2, 3 years, central banks have bought almost 1,000 tons of gold every year. 2025 is just halfway through. We have the numbers for first quarter, which were 22 billion. 22 million tons. And they will continue to be, I think, very high compared to what we've seen earlier. In fact, it's very clear that central banks purchasing gold has caused the prices to inflect higher. And this is a post-mortem. And why am I saying that? Because the rest of the market has remained relatively stable. In fact, jewelry demand has actually gone down because of prices, and it is being replaced by more and more central bank buying. Can this central bank buying continue? Now think about this, that if I'm a nation like a China or India or Japan or any other country and I'm fighting a trade war with US, and there are other wars of ammunition already happening, right? And then there are also political wars happening globally. Why would I want to increase my concentration of US dollar assets, right? So what I'm doing is diversifying and trying to buy more non-dollar denominated asset. And currently, the only non-dollar denominated asset which can comfort central banks and governments is gold. They cannot buy Chinese paper because there is lack of trust. They cannot buy European Union paper. Some are buying, but not in hordes because of the frailties in Eurozone itself. In the last 20 years, there are 2 or 3 different occasions where Euro came very close to disintegrating, the European Monetary Union, right? So a lot of people are still have questions mark on the durability of the monetary union and even the fiscal union. So the only alternate left currently is gold, and that is why it is seeing this buying. And recently, the price also broke out of the inflation adjusted highs. You can see that back in 1980s when gold was freely priced after almost 100 years, there was a massive rally and it was not able to take out that price for a very long time. Inflation adjusted price took out in 2024. For silver, the prices are still very, very low. And we made this case in the past also that silver from here on could be a much better bet than gold. But please don't make any mistake about thinking that gold therefore becomes a secondary investment. It continues to attract the whole hypothesis which I explained. And there is no reason to second guess whether what could be the peak for gold or it has rallied so much. Maybe it will bid time here, it will spend more time or decline 10-20%, who knows. But the key point is that this primary support function that gold is playing right now or becoming a reserve asset of choice I think that trend has just begun, maybe 1.5, 2 years ago, and it could be a much longer trend to watch out for. So the conclusion is that gold and silver both remain quite positive, and the outlook also remains positive, driven by these factors. At this point, given where silver is relative to gold, it might do better in price terms, but I think gold still remains the primary, mothership or the larger asset class, where the view continues to be positive. How to value gold and silver? This is an update, and currently the numbers tell us that the midpoint average for gold is somewhere close to $3,800 or 3,770, and for silver it is about $63 or so. Even the lower end for silver is close to about $52 or so, and currently silver is at 37, so it leaves a lot of room for prices to adjust higher. So that was the second section, which we concluded by saying that gold and silver both appear to be assets which can do well from here. The third is the corporate financials. What do the numbers show? And this section actually tells you what is the growth momentum in earnings, right? So first we look at the sales growth momentum. What we've done is that we've taken 5-year CAGR numbers so that we are able to see longer and less volatile readings. And then at the end, we've also given you YOY numbers for the last 4 years. As you can see that the 5-year CAGR for sales growth currently for the whole universe is about 13%, right? Which is not very high. But when you look at the numbers more recently, in FY25, the number was only 8%. And when you look at quarterly numbers, the growth momentum for sales growth is in single digit. So the sales growth momentum that we had has faded away. The top line is not growing for corporate India as well as it should have. If you go back to the 2010s, this number used to be 25% plus. I will show you a chart which will highlight what does it mean. Second is margins. Margins continue to be very, very high, and they are holding near the peak. And this is one of the reasons why corporate earnings in India have been very, very strong relatively, right? So now think about it this way. Corporate margins improved significantly post-COVID. You can see 15%, 16% margin, 15%, 15.8, right? These margins are very high. In fact, there is almost 100 to 200 basis points improvement from the previous cycle for margins. So post-COVID, when top lines grew, margins went up, PAT went up significantly. Now what is happening is that top line has stopped growing. Margins are already at peak, and we don't know what can drive margin higher. We are already at the peak. It's very hard to think that margins will go to 20%. No country in the world has corporate profit margins of more than 14, 15%. We are among one of the best. Only US technology has higher profit margins. Other than that, no sector in the world, or when you put markets together, have higher corporate margins. So one thing is very clear, that margins are very, very unlikely to go up. The only direction that they can head is down, or they can stay stable, right? So let's look at this chart. In the 2000 bull market, where economy and markets did exceedingly well, you had a very healthy top line growth and very healthy margin profile also. So not only margins were very high, top line growth was also 20% or so, right? It maintained a 10, 20% flavor. Then global financial crisis occurred, and after that, the top line once again recovered based on the stimulus, and margins held very, very strong, right? And therefore, the bull market also recovered. What we are seeing right now, initially, we saw huge margins recovery, which is still holding strong. A large top line growth recovery, which has completely deflated. It has come down. Now, the point is, can margins hold steady? We don't know the answer, right? Either they hold steady, or they come down. Either of the two. They going up is going to be very, very challenging. But what holds the key is how do the top line or sales growth pans out, right? If sales growth remains in low single digit or even 10, 12%, it will be very hard for profits to rise exponentially from where they are right now. So let me rephrase it. If profits are going to, let's say, be close to 15% profit margins, and if you have sales growth at 10%, PAT growth will come to 10% only. It cannot exceed 20, 25% because margins are no longer growing. And therefore, you can see the same profit growth momentum here. You can see when you look at the 5-year CAGR number, FY25 ended at 25% because of the low base of FY20. Excellent numbers, 20%, 22%, 25%. But look at the yearly momentum, it is down to 6% YOY. And when you look at quarterly numbers, the numbers are close to 5-6%, right? In fact, Nifty 50 did 1% profit growth in FY25, and mid and small cap did 9% profit growth in FY25. And these numbers are not changing. The Q1 numbers are likely to be 5 to 6% as per the street estimates. We don't have an estimate, but that is what street is projecting, which once again tells you that they could be in single digit. The point is that if these numbers are going to be in single digit, what will drive profits growth? And that is a big challenge for the financial health of the corporate India. What is not challenging is the balance sheet. So balance sheets are right now among the best that we've seen. And this is median debt to asset ratio. Currently, it's at 16% for the universe. And barring healthcare, which is very close to the 99th percentile, every sector, every other sector, barring healthcare and telecom, is at the best that it has ever been in terms of balance sheet strength. So this is one very comforting data. It tells you that even if we have a period of low earnings growth or any global crisis or a bear market globally, corporate India still has a balance sheet strength to tide through a crisis. That does not mean that stock prices can't fluctuate, right? It has got nothing to do with stock prices. What it tells you that corporates are in a much better shape today. And why are they in better shape? We've seen huge amount of cash flows coming to balance sheets, coming to P&L. We've seen a huge jump in cash flows. This number shows you operating cash flow margins. They continue to be at one of the highest level we've seen, 47%, which is unheard of. Historically, we haven't seen these numbers except FY15 or one time in FY06. We haven't seen this number repeat ever. So very high margins, as I showed you even in the earlier slide, and they are also replicated in the Capex numbers not coming through. So what is happening is that companies have become profitable and they are actually making a lot of cash. Their margins continue to be very high. Free cash flow yields are also very high, but they are not flowing back enough money back into the businesses. So the Capex numbers continues to be lower than what it should be. In the previous cycles, Capex number used to be at least two or three times higher than what it is right now, versus where we are in the cycle right now. Which what does it mean? That corporates have improved their balance sheets, but they have not shown enough promise to plow that money back into their businesses. And it could be because of two reasons. One, they don't see enough demand visibility or cyclical visibility, or they are still fearful of the last cycle. Either of the two. In either case, they haven't really spent a lot of money. And this is again a more pro-cyclical approach. If businesses do not invest, growth slows down inevitably because uh, government of India alone, using its fiscal space or fiscal balance sheet, cannot bulwark the whole economy. It cannot take the economy higher on its own. Corporate sector has to do its own work, right? And currently it is not doing it enough. The capex growth is much lower. So when you put these numbers together and look at the valuations, so I told you that sales growth is dismal, profit margins are high, but if profit margins continue to remain high and sales growth is 5 or 10%, profits will not grow at 20-25%. And corporates are not doing enough investments. Again, their balance sheets look splendid, but if they are not doing investments, where will the next round of profit growth come from is questionable. And if profits do not grow at 20% plus, why would the market trade at 40-45 times, right? And when you look at the mid and small cap universe, stock number 101 to 500, the median number is at about 44 times. This is not the index price to earnings ratio. This is the median price to earnings number. What it does is it removes the extremities. If you look at the index number, so mid and small cap are trading at 32 to 35 times multiples, which are again very high. When you compare it to the PAT growth that we are doing, they appear very, very high. And therefore, it sends a cautionary signal. Last year, this number peaked at about 46. When it was 46, it produced 1 year of no returns and also produced a drawdown. We are back to those numbers now, right? What will it produce? We do not know, but it is a sign of caution for this universe and largely based on the projections of how profits might grow. looking at margins and top line. In fact, the median number for price to earnings for the mid and small cap universe is about 19, and we are currently at 44. So there is a lot of distance to cover. We don't know whether we'll go to median or one standard deviation or which number, but it clearly tells you that profit growth has to be much stronger from where it is right now, and there are not enough signs where that growth will come from. The next is that when you look at small and mid cap, when you compare it to the large cap category or the largest cap stocks, the largest cap stocks price wise are placed relatively much better, right? Valuation wise also they are much better, but on an absolute level, they are also not cheap. So to tide over an equity allocation today, we think that largest cap or large cap space is much more suited to be today to put incremental money. In fact, when markets had declined and gone back to, let's say, less rich valuations, we did tell you that you should be more moderate in your approach than being conservative. But we are back to the place where valuations are in a conservative zone, and it makes sense to be in the largest cap category. And in fact, we think that large cap space is today more attractive than it was in September of 24, but only on a relative basis. This is the same thing, same statement that we made last year in September or early part of July. Uh, and I think it remains true today with what the market has done. The last section is the case of missing theme in this cycle. Usually, when there is an economic recovery, we see that banking credit grows strongly. And because liquidity alone, whether it is fiscal liquidity or monetary liquidity, is not enough to improve the cycle. So people who follow economy very closely will note down that with so much which has happened over the last 10, 15 years, after 2007 cycle, we have seen rate cuts, we have seen fiscal deficit, we've seen huge amount of crisis, we've seen a response to crisis. But across all these cycles, India's M3 has not gone up. And the money supply, the M3, which is a multiplier, it hasn't really grown. And the reason for that is a dismal banking credit growth. Because you can create liquidity as much as you want by fiscal or monetary phenomena, but unless there is a converter, which means unless there is a lender and a borrower, that liquidity means nothing. And you can see that banking credit growth has been much lower than what it is in previous cycle. And that also explains to you why banking stocks have been trading at much cheaper valuation than rest of the market, but it also tells you that the economic wide momentum is also missing. As you can see in 2000s, the theme or the driver of the economy at that point in time was capex and exports. Numbers were very, very strong, right? And in 2010, the consumption segment of the economy did the heavy lifting. But in this cycle, over the last 5 years, you can see that nothing has really boomed. All three segments have done similar numbers, but the cycle is missing, or the leader of the cycle is missing. In fact, when you look at capex, top line, industrial production growth, nominal GDP, GST collection, everything is close to 10% nominal CAGR, which is very surprising, which tells you that the cycle itself is missing, or there is no leader for the cycle in the current 2020 to 2025 phase. What will take over, we don't know. You can take a lot of permutations and combinations and create stories about exports or any other segment that you feel fit. We don't know how to forecast it, but as of now, it doesn't appear in numbers, right? And when you look at what has happened and what has helped India over the last 4 or 5 years in terms of the recovery, India's corporate profitability went through the roof. So if you look at the left-hand side bottom chart, you will see MSCI index, corporate profits, they flatline, but Indian profits jumped significantly, right? And this sort of a decoupling helped India report very, very strong numbers. And this decoupling happened both in prices and earnings. And this is the primary reason why India has done well. But now, in the whole deck, you've seen that this profit recovery is driven more by efficiency gains, more by margin gains. And the driver of longer cycle, which is reinvestment through capex or top line growth, both are missing. So unless we get this momentum back of profitability, valuations either have to correct or profitability has to go up. And either of these two have to adjust. If they do not adjust, markets will produce subpar or sub-expected returns. For example, think about this. If we do not re-rate or derate, if our PE multiple continues to be 22 to 25, and if PAT growth declines to 10%, market will also produce a 10% return, right? Which is much lower than what the market or the street expects, where it expects much higher returns, right? And therefore, it is very clear that over the longer term or a 5 or 10 year cycle, markets follow earnings growth, earnings or PAT growth or EPS growth. And if that growth slows down, the returns also slows down. And therefore, it makes a lot more sense to pay a lot of attention on valuation because that is the lever. If valuations become cheaper, margin of safety goes up multifold. And currently, that lever seems to be missing. And this is what we wanted to, share in this edition. And this last slide talks about survivorship bias. A lot of time we look at company stocks, returns, assets, and we look at the outcome last 20, 25 years, and we feel that this is the future or we try to extrapolate it. But more often than not, we end up looking at only the survivors, not the ones which have perished because of various reasons. And the collective universe of those who have perished and those who have survived is actually the current set that we should look at and make our decisions.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.